Okay, so this is Jensen and Mackling agency theory. This has been kind of the predominant theory explanation of business behavior for decades. And I just want you to understand this because it's very important for everything else. I would imagine some of you already seen this. So there are the owners of business, we call them principals. Is this cutting off on you or it's okay? Can you see it? Okay.
Yeah, I see it clearly, yeah.
Yeah, and then there is management, which are called agents. And basically what happens, managers work on behalf of the principals. So the generic idea, Friedman, etc., is that the objective of agents is satisfying the principals. And in this case, more than that, is economics. And what basically a stockholder of a public company benefits is two items: dividends that are paid for them and appreciation or depreciation of the value of their stock. If you think carefully, that's really the only relationship that really matters to most stockholders. Okay, but there is this whole problem of the information that management has about the business is much, much larger than the information that principals have. Meaning, most of the times, the only information principals receive is financial statements. And even today, we discuss that financial statements, as of today, are very limited sources of information and timely, not very timely. And so there is this thing called information asymmetry, which basically said agents know much more than the principals. Also, you have to think about what does a principal want, what an agent wants. A principal wants long-term or short-term appreciation and income. Some principals want income, meaning if you are a retired person living out of dividends, you want dividends. You don't care about capital appreciation 20 years from now if you're not going to use it. And so that's the kind of motivation principals have. Now, agents get salaries, get bonuses, corner officers, cute secretaries, whatever, all kind of benefits that they get. So money spent on their benefits is money that the principals don't get. So you have to understand that there is a disagreement here. They want different things. Now, one more interesting thing that came more recently in the literature, started talking a lot about in the literature, is that the principals can basically change their objective function by creating a portfolio. So if the risk is very large on a very risky company, they buy some other companies for their portfolio that are low risk. Or they buy companies that have negative covariance of their prices with the company that you're considering. So basically, principals have a way to deal with risk that is different than agents. Agents are pretty much tied up to the objectives of the company and what's happening with the company. And basically there is this moral hazard concept, is the concept whereby the agents want different things than principals. So in theory, the agent should do what the bosses want, the principals. In reality, they want very different things, and they behave that way. There was a guy, Mr. Inmelt, and he was the CEO of General Electric, GE. Okay, and Mr. Inmelt basically used to travel on his big jet, a 727 or whatever, 707, and he took a second jet behind him just in case if he needed it. Mr. Inmelt finally left GE about 3 years ago and left GE pretty much bankrupt. And so GE had to sell a good part of their assets and totally change their balance. And GE, that was probably one of the top leading companies in the United States, now is just a much lesser company. So his objectives, he spent money, and of course, I'm sure he had arguments that his was the CEO and for the good of the company that there would be an extra plane there for him to use. But this is just kind of egregious example of bad behavior. I'll talk about Jeff Inmelt a little bit more. I had a visitor from Australia, Philomena Lang, and she was kind of external. She was external relations dean for Macquarie University in Australia, and she wanted to meet Professor Baruch Lev at NYU. Professor Lev, I'm sure your accounting student know, is probably the most published, among the most published market researchers in the world. And so I knew Baruch from other times, and so we went to NYU and paid him a visit. And well, that meeting wasn't too much of a meeting, but at the end, he stopped me and said, Miklos, can you stay behind? So I stayed behind, and he said, you know, Jeff Inmelt basically bankrupted GE. But in the last year of his tenure, they did an estimate change for estimate change for insurance that changed the estimates in $4.5 billion. And so he left with GE still in profits. Can you use machine learning to create estimates? And I went, I never thought of that. And, you know, I don't do a lot of financial accounting research. So I said, maybe. And I went and talked to Sophia Tingson. She had graduated from our program, and her dissertation was a machine learning dissertation. And then I drafted Kishing and Schwan, who were already, no, they were still here, but then they moved over to Swoofy. And we found a database, Standard Poor's database with insurance data. And the nice thing about insurance is that you have to disclose your estimates of how many damages you're going to have to pay. So payments. And so we had like 20 years of what was my estimate that I make as a reserve for future payments. And then next year, what was the actual future payment? And the following year, what was the actual future payment? So on and so on. And we bought, actually, Baruch Lev bought this database for us. And we created a machine learning paper doing that. And the results were astounding. The results were that the estimate model was, in a couple of cases, 40% more accurate than what the companies were publishing. So that convinced us that machine learning is a good thing. We got the paper published in RAS, which is a journal, Review of Accounting Studies, and said, well, maybe this is the research we need to continue continue doing. But that Inmelt's example is a moral hazard example, is where what benefited him for his bonus and etc. By the way, I think that GE actually tried to capture back some of his salary bonuses and etc. I don't know what happened with that. Okay, and of course the issue here is the compensation of the agent, is how much money this agent was paid compared with how much money actually went to stockholders. The other issues around this is that, well, we need something to make the agent behave on behalf of the stockholders. So they have this thing called the board of directors. And years ago, board of directors were basically management. Management was there, but of course, management are the agents, and therefore they act on behalf of the agents. And so progressively, the rules of the land changed, and progressively there are a lot of independent directors, directors that are not part of management, in particular the audit committee and the compensation committee. If I would ask my opinion, I still think board of directors are poodles of management. I still think, because typically the nomination committee, the people that choose who is going to be in the board of directors, are part of management, many of them. And therefore they choose people that will do what they want. And you only see boards of directors really acting up when things are in distress and there is threats of litigation or things of that sort. And so I still think that this governance, ESG, is deficient, but got much better in the last 20 years. Okay, and so there is this idea of the moral hazard. The idea of the moral hazard is that agents don't act as they should be acting for the benefit of principals. Now, one more thing to introduce us to auditors. What are the auditors for? The auditors are supposed to verify if the financial statements fairly represent, not exactly represent, fairly represent the economics of the firm under the rules of auditing. In the US, PCAOB, International Auditing Standards Committee, etc. And so what do auditors do? They see, this is what the FASB tells me that reporting should be. And this is what the PCAOB tells me how I examine the reports. And I followed those rules. I check if the reporting was correct in accordance to the auditing standards. Now, stop here for a second and think for a second. What does that mean? Reporting standards are rules of measurement. Auditing standards are rules of verification. And in order to issue an audit report, you need to understand the measurement standards, accounting, and you need to understand what your audit standards are, that you did what you are supposed to do. Now, this model is very good to explain many behaviors. It's really mainly oriented to the Friedman argument of a business is oriented towards making profit for the principals. Now, what has been contested recently is certain things like ecological good behavior are expensive, and they might not give immediate return to the principals. They might never give return to the principals, direct return, but maybe generate a little bit better ecosystem. And so the social part, good treatment of employees, good contribution to society, same kind of thing. So that's something that needs to be taught a little bit. But think about the other side of the story of what's evolving. Remember I said Europe is starting to require ESG. So if we are going to have ESG disclosure, we are going to need ESG reporting standards. That's what Europe is starting. And we'll need to develop audit standards for evaluating reporting standards. Now, the AICP in the United States have generated new audit products. And we have been doing this for a long time. I was in Bob Elliott, who is the chairman of our advisory board, and retired from KPMG 20 years ago, 19 years ago. He was president of the AICPA and advisor to the chairman of KPMG for several decades. This whole idea of Elliott was to assurance services committees. So he created the committee and came up with 54 assurance services that auditors could perform. And at that time, I was in the assurance services that finish up generating a thing called web trust. Basically, how reliable are the web opinions, the web reports, okay? And then we had the systrust, that was system reliability. Okay, those things didn't survive very well, but progressively a new set of other audit reports we call SOX. Now we have cybersecurity SOX, we have supply chain SOX, we have service organization SOX. They are kind of expanding the scope of audit standards. And what I expect is for us to create standards of auditing ESG reportings. And of course, that'd be good business for auditors. So this is basically the view of agency. Now, I wanted to mention one more thing, or two more things about auditing that are very important. The first thing is this idea of materiality. What is material? When you write a financial audit, you say, this report fairly represents this business. Why did they say fairly represent, not exactly represents? Because measurement is expensive, and if more exactly you want to measure something, more it will cost. And there is a trade-off between how much is worthwhile auditing. So they basically have this concept of materiality, which say things that are immaterial we don't want to measure. Now, it was a concept that never was really exactly specified. And people typically interpret materiality being 5% of net income. But if the company has very low income, 5% of that is, the error rate is very low. So that's not exactly what it is. But and it's a judgmental type of thing. And the other part of it is that audits cost money, and auditors are paid. And these days, they are paid a lot of money. They didn't used to be paid so much money. And that's a whole other discussion of auditor compensation, audit fees, audit representation that we need to think. And of course, there is this kind of auditor shopping thing that people talk about. And what is auditor shopping? Is you create bidding situation where different auditors can say how much they're going to charge in the audit. And then you choose the one that you don't think is going to qualify your statements. And so this idea of skepticism, meaning how suspicious, quote unquote, auditors are of your financial reports. If you just want the money, you don't do too much work and you're not very skeptical. So there's a lot of research on auditor skepticism. And then there is this whole discussion of Audit of Independence, whereby now this is a problem that has been discussed many, many times in many, many articles, but it's continued being the issue. Who hires the auditor? Is the board of directors. And that's already improvement, because before was basically management. So the auditor doesn't want to be fired because he's getting money. So he's going to be nice to management. So you want auditors that are independent despite of being compensated by management. Other models have been tried. Other countries have the government choosing who your auditor is going to be and determining what the compensation is. So this is a kind of interesting issue that is researched frequently. Okay, just finishing up. So the agency model basically discusses the relationship between management and owners, and is very concentrated on basically financial motivation of the firm, which is making money to the principals. What the argument today is that it should be wider and should be related to environment, social, and governance will be, of course, a way to make company more responsive. And of course, there are a lot of theories now about the social responsibility of the firm, the environmental responsibility of the firm, etc., etc., etc. This is going to be many studies in the future.